How would you like to be able to travel around the world? Pay off all your debt? Or buy a big house where you can sleep in the mornings and just enjoy breakfast with your family? Do you have to slave away like a celibate worker bee throughout your 20s and 30s? Or pray to Santa Claus that one day you'll strike it big in the lottery and all your money problems will be solved? No? Well, how then? By acquiring the powerful, yet simple knowledge that the rich live by and the rest merely marvel at. Hello and welcome to Alpha Finance. This is the channel to watch if you want to learn more about personal finance, investing and cryptocurrency. In today's video we'll cover how the 8 assets you absolutely need to understand if you're ever going to achieve financial independence, so be sure to watch to the end for a complete lesson in must-own assets. So, how would you like to wake up at 10 in the morning, check your phone and see that you've made another $200 last night while you were sound asleep? And, because you're a sophisticated investor, you take those profits and buy even more money-making assets. It's exactly how men like Warren Buffett and Ray Dalio became multi-billionaires. They didn't simply work 80-hour weeks as loyal employees, oh no. They bought and held productive assets, and these proverbial golden geese produce more and more wealth for their owners, whether or not they continued working on other projects. This kind of passive income or value appreciation is one of the most powerful aspects of owning assets. Assuming the asset is truly productive or has potential to appreciate, then after the initial work or investment, the equity should keep bringing in money with little or no input from you. Of course, not all assets that bring in money are completely passive or all that lucrative. Different asset classes have different pros and cons, depending on things like risk to reward, effort and time, and capital investment. In this video, we'll cover the main types of assets that can be used to make passive income, in no particular order. Let's dive in with 1. Banking services and products. Even if current interest rates and returns are somewhat low, investors still have the opportunity to generate some kind of income by keeping funds in the following accounts. Put your money in a high-interest savings account to earn more money over time. By learning where your money may earn the most interest, you can increase your savings quickly and easily. In place of physical locations, you should also consider the convenience of digital banking. Because of lower overhead than physical banks, they compensate you with more competitive interest rates on savings accounts. To give you an idea of what to expect with a typical high-yield savings account, the annual percentage yield for such an account runs at around 1.5 to 2%. That might sound underwhelming, however the typical American savings account pays out less than 0.13% APY. 2. Bonds. A bond is a kind of debt security in which the borrower, often a government or large corporation, agrees to pay back the money plus interest after a certain period of time. An effective investment strategy will include bonds. At the time the bond matures, you will be given back your original or principal investment provided that the borrower does not fail on their obligations. The average yearly return on long-term government bonds has been roughly 5%, whereas the average annual return on equities has been over 10%. The creditworthiness of the bond's issuer is a major factor in determining the bond's risk. For example, a treasury bond from the US government is considered very safe. Bond prices are also affected by interest rates. Though not as lucrative, the big upside to bonds is they largely mitigate the dangers of putting money into riskier assets like stocks or real estate. 3. Dividend stocks. If you look into any well-to-do individual, they will invariably hold a substantial portion of their wealth in stocks, and one species of equities, known as dividend stocks, which issues passive income in the form of quarterly payouts. The companies that issue these sorts of securities, which are also known as value stocks, are often more established than the companies that issue growth stocks. In the case of value stocks, the earnings of the company are distributed to shareholders in the form of cash dividends. Companies that are more focused on growth often do not distribute their earnings to shareholders in the form of dividends, since the money is instead plowed back into the company to fuel its expansion. Growth companies, on average, will eventually transform into more mature businesses that could distribute a part of their earnings to shareholders in the form of dividends after some period of time has passed. 4. Collectibles. Collectibles are objects that have a higher value today than they had when they were first put up for sale. This means that their prices have increased through time. There are many different kinds of collections, but the most frequent ones include art, antiques, stamps, books, coins, trading cards, and comic books. Collectibles that are hard to come by command typically higher prices, and the value of most collectibles tends to rise with the passage of time. Remember Beanie Babies? Even if you don't believe it, some of these soft, pellet-filled gems that are being sold at garage sales may still be worth something, at least to someone. For example, a recent search on eBay turned up a listing for the 1997 Princess Diana Purple Bear with a running price of $850,000. Although, collections like Elvis memorabilia and World War II artifacts have proven to be profitable investments in the past, this does not guarantee you'll be able to find buyers willing to pay top dollar. For this reason, continuing your education is crucial. Learn as much as you can from other collectors or pawnshop owners as well as other specialists in the area to make smart financial decisions before investing your life savings in Beanie Babies. 5. Real estate. Flipping properties isn't as easy as it looks on TV, but it still pays handsomely under the right market conditions. Basically, you buy a cheap house that needs some work, fix it up on the cheap and then sell it for a profit, much like on the popular television channel, HGTV. This strategy is known as flipping houses, and admittedly it's quite a bit more difficult than it seems on TV. And as a result of rising costs for labor, materials, and mortgages, the upfront cost of flipping a house has also increased over the past 2 years. If you don't want to go through the trouble and expense of buying and fixing houses, you can opt instead for a real estate investment trusts, or REIT. When you invest in a REIT, you can get exposure to the real estate market without actually owning any property. Organizations that own commercial real estate like malls, warehouses, and hotels are sometimes likened to mutual funds. Real estate investment trusts are often held by retirees due to the substantial dividends they typically provide. 6. Private equity. Private equity, also known as an alternative asset, provides a way for high-net-worth individuals and institutional investors to diversify their holdings, take on more risk, and potentially increase their profits compared to investments in publicly traded businesses. The minimum investments in traditional private equity firms might be rather substantial. Thus, most private equity investments are made only by institutions or very wealthy people. Prior to making any investments, keep in mind that private equity prices are not affected by the general market. The Securities and Exchange Commission requires publicly listed corporations to follow rigorous accounting processes, although private companies have greater leeway in this area. 7. Mutual funds. Investors in mutual funds possess shares in a firm whose main activity is to acquire other businesses' shares. Investors in mutual funds do not really own shares of stock in the firms the fund buys, but they do participate equally in any gains or losses incurred by the fund as a whole. Actively managed funds actively seek for opportunities, whereas passively managed funds invest in a way that attempts to mimic the performance of a certain benchmark. They aim to replicate the results of a stock index and are thus usually self-managed. Conversely, professionally managed funds have a supervisor or team of professionals who make investment decisions on behalf of the fund. Active investors often aim to generate higher returns than the market or a benchmark index, but research shows that passive investing techniques typically provide higher overall returns. 8. Certificate of deposit. Certificates of deposit, or CDs, are a special kind of savings account that often provide a greater interest rate than standard savings accounts do. Both the term duration and the maturity date, at which point it may be cashed in, are set in stone. The duration of a certificate of deposit is typically between 3 months and 5 years. CDs do not have a monthly fee but often include a penalty for withdrawing money too soon. Certificates of deposit are protected similarly to traditional savings accounts, so you won't lose your investment if the issuing bank ever goes under. Federal Deposit Insurance Corporation coverage applies to bank certificates of deposit. You should think about getting a certificate of deposit for 2 reasons. 1. To earn steady interest without taking on much risk, and 2. To have a secure location to keep money set aside for the future. There you have it. 8 excellent assets to invest in to build multiple streams of income and achieve mega wealth. And believe me, your ex-girlfriend is sure gonna regret dumping you when she sees you flexing in your new Bugatti. Finally, if you'd like to grow together as an investor community, please join our family today by clicking the subscribe button. It's free, and you can always change your mind. And if you enjoyed this video, then tap the little icon with the thumbs up, as the old saying goes. Every time you hit the like button, an angel gets its wings. Thank you all for watching. I'll see you in our next investing video.